Welcome to the Deep Dive. Today we are digging into MKS Inc., ticker MKSI, and their Q3 2025 earnings call. This one was held pre-market on November 6th, and it wasn't just another quarterly update. The market popped almost 11%. That tells you something big happened here.
It really does. Look, for anyone who's been following MKS, this company has been in the middle of a really complex multi-year change after a huge acquisition. They're now, right at the center of these massive growth trends in advanced packaging and AI. This call was basically the proof that it's all starting to work.
Okay, so let's unpack it. Our goal for this deep dive is to get into the financials, understand what management is saying about this long-term AI and chemistry story, and really get to the heart of the conflict here. You've got these huge structural growth drivers on one side and these lingering cyclical drags on the other. We need to figure out why the market is now betting so hard on that growth story. Let's just start with the headline numbers because, frankly, they were undeniable beats. Revenue came in at $988 million. That was way ahead of the street's estimate of around $964.
And that's a solid 10% gain year over year. Very strong.
And the profit side was just as good.
It was. Non-GAAP diluted EPS hit $1.93. The consensus was, somewhere closer to $1.83, $1.84?
Yeah, so a solid beat there too. But what I found even more compelling was that this wasn't just about looking back.
No, not at all. It was all forward-looking.
Exactly. They signaled an acceleration. The Q4 guidance, the midpoint, is projecting revenue of around $990 million and non-GAAP EPS jumping to about $2.27.
That is a huge sequential jump they're guiding to for the end of the year.
So what does that aggressive guidance tell you?
It tells you management has a very, very high degree of confidence in what they're seeing. It says that even with all the macro uncertainty out there, their specific piece of the world, this advanced manufacturing space, is, really firing on all cylinders.
So let's drill down. Where did that strength actually come from? Because one segment was just, it was the star of the show.
Electronics and packaging, E&P. It was the runaway powerhouse.
$289 million in revenue. That's up 25% year over year, 25%, and 9% just from the last quarter.
That segment is pure AI leverage right there.
And even the semiconductor segment was strong, right?
Oh, very robust. $415 million in revenue, so that's 10% year-over-year growth. And that 10% is a really powerful number.
Why is that?
Because management was very open about the fact that they saw limited NAND upgrade activity in the third quarter.
And for anyone listening, what's the significance of that NAND detail? Why does that matter?
It matters because NAND flash memory is, it's one of the weakest spots in the whole memory market right now. Demand is slow, pricing is tough. So for MKS to post 10% growth, even with that headwind, it means the demand they're seeing in other areas like deposition and etch subsystems is just incredibly strong.
The building blocks for future stuff.
The absolute foundational building blocks for next-gen compute. Exactly.
Okay, so strong top line. But the other side of this, and maybe the more important part, is the financial health story. This is what's de-risking that whole AI thesis for investors.
It all comes down to cash generation and paying down debt.
And the discipline here was, it was impressive.
Paramount. Operating cash flow was $197 million, which led to free cash flow FCF of $147 million.
Which is just a massive number.
The conversion is phenomenal. That FCF is over 100% of their non-GAAP net income. It's 15% of revenue. You don't see that very often.
And they are putting that cash right to work on the balance sheet, just chipping away at that big debt pile from the acquisition.
Precisely. That deleveraging focus is the ultimate proof that the operation is disciplined. They've paid down $400 million in debt just this year.
Including a voluntary payment in October.
Yeah, a voluntary $100 million term loan prepayment in October alone. That brought their net leverage ratio down to 3.9 times.
And bringing it down to 3.9x, that's a huge milestone. How does that change things for them?
It fundamentally changes the entire investment case. Look, every $100 million they pay down early is $100 million of risk just taken off the table. It lowers their interest costs, and it starts to change their valuation multiple from, say, a leveraged turnaround stock to more of a growth stock. They're on a clear path to their 2.5 times target, and they're way ahead of schedule.
Okay, now we have to touch on the margin noise, tariffs specifically. The GAAP gross margin was 46.6%, and the explanation here was a little bit nuanced.
It was. So tariffs hit the Q3 gross margin by about 80 basis points. But the important thing is that management said they have mitigation efforts in place starting in Q4 that will offset the cost of the tariff dollar for dollar.
So just to be crystal clear for you listening, they aren't actually losing cash profit from the tariffs. They're passing the costs through to the customer, but it's zero margin.
That's the key takeaway. They've managed the profit hit, but because that revenue they're passing along has no margin on it, it structurally dilutes their overall percentage gross margin.
By about 50 basis points going forward.
Right. It's a permanent mix shift in the numbers, not a hit to the actual dollars in their pocket.
Okay, so we've got strong financials taking care of the debt, which was kind of the first big hurdle for this company. So now the real question is, are they actually building a high growth business on top of that?
Right.
Let's get into that long-term AI and chemistry story. This is the future they're selling.
And this is the core structural tailwind. Management was, they were emphatic about AI servers and advanced packaging being their growth engines. And the specific opportunity they talked about is just fascinating. It's this rapid increase in PCB and substrate layer counts for high-performance computing.
How rapid are we talking?
Well, historically, these boards had maybe 20 layers. Now we're seeing an immediate jump to boards with 40 layers. 40. And their customers are already planning for roadmaps that have 80 plus layers. 80. That's like building a skyscraper on a microchip. And every single one of those layers needs their proprietary chemistry and their specialized equipment to connect it all.
So that layer count explosion is the long-term tailwind for MKS.
That's it. Every single new layer is another sale for their process chemistry, their metrology tools, their laser drilling systems. It's a huge compounding opportunity.
And to really understand how the revenue flows, you have to get this lead lag dynamic. It's basically a razor and razor blade model, isn't it?
That is the perfect analogy. The expensive equipment they're selling today, which management said is running at the high end of its historical range, that's the razor. It's the leading indicator.
And the chemistry is the razor blade. The steady, high-margin sales that keep coming.
That's the payoff. But because of these long customer qualification cycles that chemistry pull through the consumables revenue, it usually follows the equipment sale by about 6 to 12 months.
So the strong equipment sales they're booking now are really setting them up for a much stronger, higher margin 2026.
Exactly. It's a tell for what's coming down the pipe.
But is there a real moat here? Can't competitors just catch up on the chemistry needed for all these new layers?
The moat is really built around the integration. This isn't just, off-the-shelf chemistry. It's highly proprietary stuff that is qualified to work specifically with MKS's own equipment and laser systems. The qualification process for AI compute is so stringent that it creates a very real barrier to entry. They're selling a whole solution, not just a product.
Okay, let's pivot. Let's talk about where management was a bit more cautious. Where's the cyclical drag still showing up?
Yeah, while that AI story is just rock solid, they're still very careful on the broader outlook. They pointed to industry expectations that a real wafer fab equipment, or WFE recovery, won't happen until the second half of 2026.
So they're not calling for a widespread recovery just yet.
Not at all. They're executing on their own story, but they're not getting ahead of the macro cycle for the general semi-space.
And we also saw that weakness continue in the specialty industrial market, the lasers segment.
Correct. They pointed to soft industrial PMIs, hovering right around that 50 mark. Anything below 50 means contraction. So they're basically waiting for a clear macro signal before they call a recovery there.
So the message is, don't confuse our AI growth with a broad economic recovery.
That's it. The latter's still waiting.
And they also touched on geographic shifts, this China plus one trend.
Yep. They confirmed they're building new capacity in Southeast Asia to follow their customers who are moving out of China. And they also made it clear that their direct semi-equipment exposure to China is, it's mostly excluded from their numbers anyway because of trade policies. It lets them focus on what's happening everywhere else.
So this combination of great numbers and this really compelling AI roadmap is what led to that huge market reaction.
Right.
The stock closed up, 10.96%, hit a new 52-week high, and the volume was almost 1.7 times the average.
That kind of move, on that kind of volume, that's a signal. It's a real change in consensus. And look, year to date, the stock is up around 38%. The market is finally getting the new story.
So how would you sum up that shift in the narrative? What's changed?
They've successfully gone from being seen as this, leveraged integrator just trying to digest a big acquisition to being recognized as a foundational supplier for AI packaging and semi-subsystems. And the balance sheet getting cleaned up so fast just gives them the stability for the market to finally focus on that growth.
But there's always a bull and a bear case.
Yeah.
What's the lingering skepticism, especially after a pop like that?
The skepticism is really centered on valuation. Some folks are flagging that the rally might be getting a little ahead of itself, given that equipment sales are historically so cyclical.
So investors are still wrestling with the old identity of the stock.
Exactly. They're trying to figure out how much of this is real structural AI demand versus how much relies on a future cyclical recovery. And, that tariff noise is always a low-level concern in the background. The bulls are winning right now, but the weakness in their industrial segment keeps a lid on things.
And now for our segment. This is not financial advice. We take the data from the call and build an outrageous but plausible trade idea, sort of like an analyst pitch.
All right, lay out the pitch. Focus on that conflict between the structural growth and the cyclical drag. Trade thesis. Okay, so our thesis is this. We believe the market is still structurally underappreciating the multi-year pull-through of that high-margin chemistry revenue, the revenue that's tied to all the AI equipment being installed in 2025. Investors are still too focused on the macro-sensitive parts of the business, like lasers and general industrial, and it's obscuring the AI signal. The roadmap's from 40 to 80 layers that fundamentally validates this chemistry story for the next 5 years. Proposed trade. We propose initiating a long position in MKSI equity. We see the clear deleveraging path and the high free cash flow yield as fundamentally de-risking this AI packaging bet. It provides a high margin of safety. And we think this long position should be partially funded by a short position in a pure play industrial company that has high exposure to those soft PMI trends. This is a targeted bet that MKS's structural AI story will just crush its cyclical industrial parts, at least until that WFE upturn in the second half of 2026. We are buying the pull-through.
That is definitely a focus play. It really gets to the heart of that structural versus cyclical story happening right now in MKS. Okay, to wrap up our deep dive on MKS Inc.'s Q3 call. They delivered huge beats, showed amazing discipline by paying down $400 million debt this year, and most importantly, they painted this really vivid picture of a future driven by that 40 to 80 layer AI substrate roadmap.
So I'll leave you with a final provocative thought to chew on. Given how strong and ahead of schedule these equipment sales are, what if that customer qualification time for the high-margin chemistry starts to shorten? What if, instead of the historical 6 to 12 months, it gets streamlined down to, say, 4 or 5 months because the demand is so urgent? Could that pull forward all that high-margin revenue, dramatically accelerate their free cash flow, and get that balance sheet cleaned up well ahead of their 2027 target? It could make 2026 the absolute peak of this whole transformation.
An acceleration of that high margin revenue would fundamentally re-rate the entire company. Thank you for joining us on the deep dive. Consider those implications, and we will see you on the next one.